What we are witnessing right now is by no means standard market noise, but a structural red risk signal. This signal stems from a breakdown in the market's microstructure. If you tap into the liquidity data feeds of dark pools at this moment, you will observe an extremely anomalous phenomenon. Large institutions are executing covert algorithm-driven sell programs. Current pricing models clearly indicate a severe valuation dislocation between the $87,000 asset price and its actual fundamental fair value. This deviation has reached extreme statistical significance in terms of standard deviation. The violent price fluctuations over the weekend were by no means a random walk. They constituted a classic textbook-style liquidity event. This was a deleveraging operation dominated by high-frequency algorithms, striking with surgical precision. It acted like a scalpel, precisely eliminating momentum traders who were underhedged, overleveraged, and completely disregardful of balance sheet health. Please make sure to lock onto core data and ignore superficial price swings. We need to interpret the structural implications behind the surging implied volatility. These are not just numbers flickering across terminal screens. They are the brutal settlement records left by high-frequency trading, HFT, on order books over the weekend. This is a classic capital squeeze. If you ignore such obvious risk exposure, you are turning a blind eye to the highest level systemic warning issued by the market. Let us rewind the timeline and re-examine market behavior with second-level precision. Last Friday, Bitcoin hit a technical high, attempting to breach the key psychological and technical resistance level of $91,000. Market sentiment at the time was in the extreme greed zone. According to my monitoring, retail consensus showed a one-sided bet, convinced that prices would break the $100,000 mark before Christmas. In their linear extrapolation models, the upside seemed limitless, but at the very instant sentiment peaked, the liquidity trap was triggered without mercy. This was a complete position liquidation. This was not a technical correction, it was a public execution in the capital markets. However, the subsequent price action played out a classic Wall Street reversal script. Just as you prepared to stop loss out of panic, market makers activated their mean reversion algorithms. Bitcoin seemed to be taken over by complex algorithms and began a strong rebound. It miraculously recovered from the low of $82,000 to the $85,000 mid-range on Saturday, then surged to $87,000, driven by volatility. After consolidating on Sunday and Monday, it even attempted to test the $88,000 resistance level. At the moment I am writing this in-depth research report, the price remains stubbornly, even irrationally, anchored at the $87,000 level. This is not just confusing, it is a warning sign. This is not trading. This is a carefully engineered risk game, a structural bull trap designed to lure the last batch of retail investors into the bag holding zone before the macro storm hits. Terminal backends are now flooded with questions. Is the V-shaped reversal valid? Has a new bull market cycle begun? Is the bottom structure confirmed? Is $100,000 the established alpha target? As an analyst with 20 years of experience, I refuse to sugarcoat risks. Over the past 48 hours, I have continuously monitored the Bloomberg terminal, deconstructed every extreme candlestick, interpreted the Federal Reserve's policy hints, and tracked the movements of on-chain whales. The conclusion is unequivocal. I do not cater to market sentiment, I only reveal the brutal market truth. And the truth is, the downside risk exposure at the current $87,000 is exponentially greater than it was at last week's $91,000 high. This is by no means a so-called value depression, nor is it a discount entry point. This is the final calm before macro liquidity tightening. Market makers exploited the weekend window of depleted liquidity to artificially prop up prices, creating a false sense of technical strength and constructing an enticing bull trap solely to lure retail capital into providing liquidity at local highs, allowing them to complete their distribution of holdings. Before delving into fundamentals, I want to reaffirm core investment principles to safeguard the capital of our community. The trend is your friend until a reversal signal is confirmed. We need to seize the initiative in this zero-sum game, not be the last bag holder. Now, let us conduct an in-depth attribution analysis. The massive volume profile reveals a harsh truth. Institutions are in the process of distribution. This is not retail panic selling. It is sovereign funds and family offices systematically liquidating positions at market highs. They are locking in profits, and their operations are designed to trigger maximum market volatility. According to Dow theory and microstructure analysis, this oversupply will require weeks of consolidation, a period of chip swapping to be fully absorbed by the market. The market needs time to repair damaged technical indicators. But what actually happened? After the weekend opening, prices drifted slowly upward against a backdrop of absent macro bullish catalysts and no fundamental drivers. Note my choice of words, drifting. This was not a powerful reversal. It was like a feather without support, floating with the wind. I dug deep into trading volume data, and the conclusion is shocking. Compared with the massive sell-off on Friday, trading volume over the weekend shrank significantly. Buying interest during the recovery phase was extremely scarce. This is a highly dangerous divergence signal. Let us lift the veil. The support base at $87,000 is extremely fragile, built on three shaky assumptions that are overextending future gains. Technicals have issued a trap alert. The rebound reached $88,000, but painfully failed to break the previous high of $91,000. This technical pattern is textbook material. The current pricing is stuck at $87,000. The market is undergoing a brutal stress test, testing the willingness of speculative capital to chase highs. The market is asking, how much premium are you willing to pay for an asset that depreciates 10% in a single day? If buying interest fails this test, prices will break through the psychological barrier of $80,000 and rapidly revert to value in the $70,000 range faster than you can react. The market's reaction seems to anticipate the Federal Reserve launching a helicopter money drop. Following the recent release of weak employment data, pricing in the swap market has spiraled out of control. The implied probability of a December rate cut has soared to an incredible 81%. Consensus trades are betting that Powell will open the liquidity floodgates, driving a revaluation of risk assets such as Bitcoin. During Friday's crash, a large number of retail investors rushed to buy puts to short the market. But institutional market makers are savvy and experienced at hunting liquidity. In the low liquidity environment over the weekend, it took only a minimal amount of capital to manipulate prices, pushing them above $84,000 and then breaking through $85,000. It was like injecting adrenaline into the market. Once short covering ended, the momentum came to an abrupt halt. Look at the current situation. Stagnation, frozen, stuck at $87,000, with a lack of genuine buying interest above. Above, $90,000 forms a massive supply wall, where billions of dollars in trapped long positions are stranded. This is a wall of pain. Below, $80,000 is the last psychological line of defense. If tested again, it will shatter like thin ice. The sideways consolidation at $87,000 is boiling the frog slowly. Mainstream capital needs time to unload huge positions without causing a crash. Maintaining this false strength and creating an illusion of a soft landing at $87,000 keeps retail capital flowing in, completing the chip swap. This high-level distribution is an invisible killer. It gives hope, discourages selling, and lulls you into the illusion that riding out the volatility is wise until the market structure collapses and you realize you have become the final bag holder. But we are not victims, we are risk managers. No gambling, only analysis. No chasing fantasies, only following data. I know the temptation to buy the dip and chase the $100,000 target is irresistible. But our duty is to target the optimal risk-reward ratio and minimize downside risk. Be the hunter, not the prey. Do not view Bitcoin merely as a chart. View it as a narrative cycle, with your principal as the protagonist. We were once in the comfort zone of a bull market, turning a blind eye to overbought signals. Market complacency at $90,000 was a case of normalcy bias. Now we are in a risk-release phase. The drop to $80,000 was a wake-up call. This was a violent valuation reversion. This is not a disaster. It is an opportunity to seek genuine alpha, not a reason to panic sell. Now we face the most daunting challenge. Maintaining short position discipline. Tune out the deafening noise of FOMO, fear of missing out, at $87,000. This is the valley of death for investment portfolios. Discipline is forged here. A risk-first strategy is your moat. Completely ignore the temptation of $87,000. Focus on long-term fundamentals and market depth, not short-term noise manipulated by options. The $90,000 resistance level is the biggest obstacle, with billions of dollars in trapped capital. Breaking through it will require massive institutional incremental capital. There is currently no sign of this. The market is not ready to cross this supply wall. As for the $80,000 support level, it was previously barely maintained by gamma squeezes and short covering. A second test will encounter large-scale institutional shorting. My prediction is, if it breaks below $80,000 again, it will seek liquidity at $75,000 or even lower levels. Golden rule. Never bet on a breakout in this structure. I know you want to go all in. You must resist. You must wait. The bullish narrative is built on a deviation in Fed rate cut expectations, which is precisely the bait for the squeeze. Viable strategy. Wait for the true value zone. If you must enter the market, start with a tentative position first. Only consider a minimal speculative observation position if prices stage a volume-supported rebound around $78,000. This would indicate the entry of genuine buyers, not a short-term squeeze. The ideal strong entry point would be a further correction below $70,000, around the $72,000 level. This would flush out weak-handed chips, eliminate leverage bubbles, and provide a genuine discount price for the next long-term uptrend. Cash is a position. At this moment, it is your greatest advantage. Every dollar is ammunition reserved for future discounted chips. It is capital waiting for a genuine signal. They need to absorb liquidity at high prices to avoid a flash crash. Sideways trading at $87,000 is the ideal distribution range. They use this false stability to sell in batches to panic-stricken FOMO investors. High-level consolidation is psychologically destructive, fostering the cognitive bias that consolidation equals health. I challenge the mainstream view. The consensus believes prices will rise to $100,000. But based on data, I point out that the market's microstructure is extremely fragile. This rebound is a technical repair and psychological warfare, not the start of a fundamental bull market. We do not chase rallies. We anticipate downside risks. This is the alpha strategy, the secret to sound sleep at night. First, there is liquidity risk. The real selling wave is yet to come. The weekend rally was built on hollow sentiment and thin order books. Market depth is extremely poor, like a building without steel reinforcement. If whales possibly associated with government selling decide to dump their holdings, the speed and slippage of the price drop will far exceed those seen on Friday. There is no buy wall to absorb the selling pressure. This will be the true liquidation moment. Potential downside risk. Volatility will be extremely high. Finally, there is the risk of incremental capital exhaustion. FOMO-driven retail capital is not unlimited. Inflows have been sustained since October. Recently, most chips are in the hands of weak hands. If prices stagnate at $87,000, new entrants will lose patience and turn to selling. Selling pressure will become a self-fulfilling prophecy, triggering a price spiral downward. Clear positioning. I am a cautious, long-term bull. I believe in the prospects of this asset class, but I do not endorse the current valuation multiples or the fragile liquidity structure. Therefore, position management is definitely not going all in. Risk exposure should be extremely low. When entering the market, upon receiving confirmation signals, establish a risk-weighted observation position that can be held long-term even if prices pull back 50%. Summary of core views. $87,000 is a technical trap, supported by fragile option squeezes and excessive speculation, which could collapse at any time. The evidence is conclusive. Volume divergence over the weekend, long-term holders reducing positions at highs, and massive selling pressure at $90,000. The strategy is clear. Maintain a cautiously bullish stance, but this is not the time to buy. Patience is required for a secondary test. Tactical positioning is targeted in the $78,000, $80,000 range, with structural entry expected in the $70,000, $72,000 range. The market specializes in punishing impatient capital. It preys on FOMO, then sends margin call notifications. You need to take the initiative, and that comes from having a trading plan. Now, I need your feedback. This is a two-way dialogue. Please comment. Where will the bottom be in the next 30 days? Are you waiting patiently for a right-side trade like me, or feeling the pressure of missing out and chasing $87,000? Everyone, if you agree with this logic, please like and subscribe. This shows that you pursue unvarnished truth, data-driven analysis, and a risk-first mindset. We are an institutional-grade investment community. Let us navigate the cycle together.